Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's 128th CP program organized by AASB of ICAI this year. As we all are aware that we have already covered all the standards on auditing, all the auditing aspects of the line item of the balance sheet, asset side, liability side, as well as we have started our series on various industry-wise key consideration on audit of various key industries. Today, the topic is very relevant and very important, that is the internal financial control. In order to tackle this, we are having with us our today's learned speaker, CA Priyanshu Gandhana ji. So, on behalf of AASB of ICAI, I extend my warm welcome to you, today's speaker, CA Priyanshu ji. We are also having with us our Honorable Vice Chairman, sir, CA Vishal Doshi ji. So, I welcome you, sir. So, before we formally start, I request our Honorable Vice Chairman, sir, CA Vishal Doshi ji, to please share his words of wisdom and his opening remarks. Over to you, Vice Chairman, sir, please.
Thank you, Anilji. Very good afternoon to Priyanshuji, Anilji, and all the participants to this 128th event of the AASB. Friends, it is indeed a pleasure and extreme happiness as Vice Chairman of the Auditing and Assurance Standard Board that we have been able to share an eminent knowledge with our fellow professionals in physical mode through various branches as well as in virtual mode through the AASB and the office that this is the 128th event. And like Anilji already mentioned, we have been able to cover all the auditing standards, all the audit procedures with respect to assets, liabilities, a few of the aspects of the guidance note also. And I would just share that the love and affection that we have got from all of you is visible, that almost 184,000 participants have taken benefit of this knowledge sharing, knowledge dissemination sessions. And that also many of them where there are no, structured CPE that is available, especially on these webinars mode from the month of August. That where there is no structured CP, and then also we find large participation in the events. That itself speaks a lot about the inquisitiveness of our members, where they are, ready to learn, especially on the auditing aspects, which is the core of the chartered accountancy profession. So I extend my warm welcome to all of you, and also a heartfelt thanks to all of you who have made AASB so successful this year. Friends, the topic that we are going to discuss today is the internal financial control over financial reporting. We have an expert in Priyanshuji who is going to take us through the nuances of the ICFR, ECOFAR. It's been, it has various short forms that people use through the audit firms as well as the audit committees, I would say. And but ultimately, the importance is such that it is an area where now all the audit committees, especially I would say, will give a lot of stress on the internal financial controls over financial reporting. And I would say that a step forward, that I have also myself attended audit committees where the independent directors are also aware of the guidance note of our institute with respect to the internal financial controls and what are the areas that an auditor is expected, or I would say the management as well as the auditor is expected to cover before they give a certification under internal financial controls. Like you have the, the IT general controls and the specific, the risk matrices and all those things. So, and I feel very happy on behalf of the institute and also as the AASB Vice Chair that there is so much of awareness that has been created on the internal financial controls and the importance that the IFC has when we talk of the financial statements as a whole. Without taking much time, I would now request Anilji to take the session forward, and also Priyanshuji for thanking him for sparing his valuable time in sharing his experiences, his thoughts, his views on the subject. And I would say highly confident that it would be a very, very fruitful and extremely enriching session with Priyanshuji. Thank you, Priyanshuji, once again on behalf of AASB, and thanks to all the participants for giving me this opportunity to interact with you. Over to you, Anilji.
Thank you so much, sir. Thank you so much for your words of wisdom, sir. Before we formally start our today's webinar, it is my proud privilege to share with all of you the brief profile of our today's learned speaker, Shri Priyanshu Bandaraji. Shri Priyanshu is a chartered accountant with 25 years of experience. He is leading and delivering auditing services to clients in the broad range of industries across various geographies. He has undertaken such assignments in sectors such as energy, infrastructure, transportation, and logistics, oil and gas, pharmaceutical, media, entertainment, chemical, retail, and consumers, etc. He has assisted organizations in process design, implementation of internal control, thereby ensuring reliability of financial reporting, effectiveness and efficiencies of the operations, safeguarding of assets, and compliance with applicable law and regulations. He has been a trainer on various soft skill topics like leadership styles, stress management, conflict resolutions, etc. He has also delivered various seminars, webinars, as well as virtual CP meetings during COVID also, as well as throughout the year at various platforms organized by WSP of ICI. Since time is short, list is very vast. So without wasting much more time, I request Priyanshuji to please deliberate on the topic and enlighten all of us on various intricacies on internal financial control. Over to you, Priyanshuji, please.
Thank you, Anilji. Thank you, Vishalji, for giving me this opportunity to present a very interesting topic on IFC. And as Anilji, as Vishalji rightly said, I mean, in today's world, this has become a prime importance, and the way audit committee is looking at IFC, the way stakeholders, investors, bankers are looking at IFC, which is the controls which and how the company performs. And for us as a profession, this is the right time to refresh our knowledge because we'll be starting our IFC checking or testing in the month of Feb and March as we approach the year ends for listed companies and large unlisted companies. So my endeavor would be just to go through some of the facts and how IFC works. I mean, refresh it kind of a course, and happy to take any questions and we'll take it forward. So I have a short presentation which I would like to first start with, and then happy to take any questions as we move forward. So during this 1.5 hours, what I'll try to do is I'll try to cover the overview of IFC, what actual control means, because it's very important that we try and understand the difference between a control and a process. Then I'll just try to look at the 5-step process which we need to follow at the planning stage. Whenever we test a control, we actually try and see what could go wrong and what kind of a control we have to address that. So we'll touch upon them. We will try and see what would be the assumed wrong, which is risk of material misstatement, which is the specific risk. We'll try and understand what the ELCs, which is the entity level controls, and the PLCs, which is the process level controls. We'll try and just look at the design and implementation of controls. We will talk about the plan and performing operating effectiveness testing, how we do that. We will also see how we should evaluate a control deficiency, because that's very important at the end of the day, because there are implications both from a reporting standpoint as well as the way we do our audit, and what are the other considerations on an audit if through IFCR. So let me start with an overview. Why IFC and why IFCR? I mean, this was something which came up in March 31, 26 or later, where the Companies Act 2013 required first the directors of the company to report on the adequacy, existence, and operating effectiveness of the IFC. Now, if I look at it, are we saying we never had controls before March 31, 2016? We always had controls, right? When we used to do our audits, our auditing standards also talked about controls. And when we used to do our audit, we used to also rely on those. But we used to never explicitly opine on that particular control. Now look at it the way Companies Act is looking at it, saying that one is we do a traditional way of doing an audit, but at the same time, the regulators, today's investor community, the stakeholders want to also understand that the process and the way things happen in the company are not a human dependent kind of a activity or an individual dependent kind of an activity, but there is a set of process, set of controls which are inbuilt, which is at a designated level. And that is something which they want comfort on. And that's how the Companies Act 2013 came up with the requirement where the directors had to report on the adequacy, existence, and operating effectiveness of IFC. It also stated that the auditor will also provide a separate and a distinct opinion on the adequacy and operating effectiveness of entities' internal control over financial reporting. So, what is the difference here is that while the directors has a responsibility to give a report on the adequacy, existence, and operating effectiveness of all the internal financial controls end to end, which may somewhere include operating controls also. However, as an auditor, we are required to only give our opinion on the adequacy and the operating effectiveness of internal financial control over financial reporting only. ICAI has come up with an excellent guidance note in the month of September 2015. And what it talks about, it links back to the SA 315 on identifying and assessing the risk of material misstatement to understanding the entity and its environment as framework, right? So it really helps us to cover up the requirement of SA 315 in the way the controls get effective and operated. This guidance note is also drawn from the global standard, which is existence, like US PCOB auditing standards. Now let me look at it in section wise version. So if I look at section 143, the auditor's report would state whether the company has an adequate IFC system in place and is operating effectiveness of such controls. Now it applies to all listed, unlisted public and private limited companies, right? In case of a component included in a CFS, reporting under IFC would be applied on a respective component only if it's a company under the Companies Act. So what does it mean is that if there is a body corporate or there is a private limited or a what you call a partnership firm or a company incorporated outside India, IFC may not be applicable for that particular company. But as an auditor of a parent company, we should also apply the concept of materiality related to IFC and see that if that particular component is material to the overall financial statements, then even if that particular legal or a local requirement is not there about giving an opinion on operating effectiveness of a control, uh, as a parent auditor, we will have to instruct to that component auditor to carry out these additional procedures and give an opinion on the IFC systems and the operating effectiveness of those controls. Following are the broad requirements as per the guidance note. First, I mean, it's very important to know that what is our reporting requirement and what we have to report and how we have to report. First, as an auditor, we are required to obtain reasonable assurance and state whether the internal financial control system which exists is adequate to the size and the nature of the business. We also take a written representation from the management on the effectiveness and the effectiveness of the control design and operating within the organization. Now, what does it mean? Written representation means that management should have tested those controls and should have concluded that it is operating effectively, both from a design as well as the efficiency basis. This means that you have to also check the process followed by the management in carrying out this actually activity. While the standard on auditing does not fully address the IFCR point of view, there is a guidance note which gives you a detailed plan procedures on IFC and what kind of a report is required to be issued by the auditors. Now, this is a very important point. Auditors should report on the design and operating effectiveness as at the balance sheet date. Now, what does that mean? When we do an interim audit, which is before the year end, say if the year end is March 31, 2023, and we have already started our work in the month of December, and you have found out that there is what you call a design defectiveness or a material weakness in the control, the company has time to remediate that particular material weakness or a significant deficiency. And when you retest those controls as at the balance sheet date, and if it is working effectively, then our audit report would be clean enough to say that the particular control is designed and is operating effectively as at the balance sheet date. Okay, so that's the piece that where an auditor is required to report the operating effectiveness and the design as at the balance sheet date. Reporting on management assertion is not required. And what does that mean? Auditor cannot rely on the work or a testing done by the management. Auditors have to make an independent assessment, do the independent testing and the walkthrough, and come up with an opinion, which we call it as a integrated opinion in our financial statements. What is the criteria for an internal control? A benchmark internal control system is based on a suitable criteria, and that means is that it is enabled by the management, and the auditor is to assess the state of adequacy and compliance with that particular system. Our guidance note on internal control components and the appendix 1 of SA 315
Sir,
really provides.
apologies.
Yeah.
Sir, you are sharing your PPT or you will share at the later stage?
No, I'm sharing it. It's not
No,
coming.
sir, it's not coming. That's why I was wondering the PPT is
No,
not
no, no.
coming.
I thought it's coming now. I've shared it. Okay, let me reshare it. Okay,
No,
sorry.
sir, not yet, sir. That's why I was
Oh,
wondering.
okay, 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 okay. Let me stop sharing and reshare it. Okay, one
Yes,
second.
sir.
Now it's coming.
Yes, sir. Yes, sir. It is coming, sir. Coming, sir.
Okay, okay, okay.
Fine,
Sorry,
sir.
sorry
Fine.
about it. I thought
It's
it's
okay.
sharing because I can see it's sharing.
Fine,
That's the
sir.
reason. No problem. Now let me look at the five internal control components of SA 315. The reason why this is very important is that our process and the control mapping and the way we actually follow the control is based on these five pillars which we tell you. One is we look at the control environment. And what is this control environment? Control environment is technically tone at the top. Okay, it talks about integrity, it talks about ethical values of the senior management, board of directors, promoters, right? It talks about participation, extent of participation of those that which governance, what are the management philosophy, the operating style, what are the HR policies, right? How does the organization structure look like? What kind of authority and responsibilities assigned to each of the senior management level and each designation? What is the kind of involvement a promoter has as vis-a-vis the professional management? So all these things we talk it as a tone as the top. It talks about the control environment of the company as a whole. Then we look at the entity's risk assessment process. While we look at the control environment, while we talk about the overall philosophy, governance, integrity, ethical values, it then leads to what is the process management follows to identify the relevant risk in preparing the financial statements. Because at the end of the day, when you have a strong control environment, they should be able to identify the potential risk which comes up while drawing the financial statement, because then only you can design the control to prevent those risks turning into a casualty, right? And that's how I'm saying that when we what they identify the relevant risk and the process which they follow to actually link that particular risk to the actions is the way we look at it. Now, once you have a strong control environment, once you have identified the relevant risk, once you have determined that there should be an action to be managing those risks, now it comes as actual control activities. What does that control activities? The control activities is nothing but a set of controls which are built into a particular process to ensure that the likelihood of that particular misstatement or potential risk which has been identified is mitigated and is put to a acceptably low level. We can never say the risk is completely out. We always say that it can be put into rest in an acceptably low level, right? So when we look at that, what are the kind of control activities if you look at it? Performance reviews. These are so when we build controls, there are 3 or 4 type of controls which we build. One is process reviews. Now, what does process review means? Process review means that basically somebody is reviewing a particular activity or a particular bunch of activity at the end of a particular process or after a periodical interval. So that's an overriding control where somebody independently looks at the data, reviews the data for any exception. Then we have an information processing control. Information processing controls are nothing but controls which are inbuilt in the way the information is actually processed within the system. For example, a revenue to receivable, who raises the invoice, who raises the what you call invoice, how a GRN is approved, all that kind of controls. Then the third is physical security. Physical security, both from an IT environment perspective, also from a basically physical access to office, physical access to IT rooms, how the files are kept, lock and key, passwords, etc. And the SODs. SODs we all know, segregation of duties in terms of is there an overlapping work being done by the same individual, like what we call it. Do we have a maker checker check on that front? Fourth talks about information systems and the communication. Now, what it means? It means that it includes a relevant financial reporting business process and how that particular activity and the control is actually communicated. And the second point which it looks at is the quality and the reliability of the data which is generated out of systems. Now, what is important here is that if there is no maker checker check or there are a certain test which does not go well in the IT system where somebody can manipulate data from backend, the report which gets generated from the system cannot be relied, right? So we will have to look at those parts separately. Now the fifth point is whatever we talk about 1, 2, 3, 4, is everything working well? That's monitoring of the control, right? So the management independently actually reviews and ensures that the operating effectiveness of the control activity is in line with which it was desired to be designed for. There are ways and means of doing this, right? I mean, there is an internal audit system within the organization, or there are external internal auditors who actually picks up the RCMs and run through the process to give comfort to the audit committee or the board members to say that the controls which are set out in the document is working effectively. There are information and communication coming in from external parties, customers, regulators, auditors, third parties, stakeholders. They come up and say that is this working effectively or there is a problem there. based on their interaction with the company's management. Let me just put across some summary of content in the guidance note on IFCF, because this is our Bible as auditors. The guidance note is very well drafted, and this is our Bible whenever we go for an ICFR audit. Part A talks about the overview, which is nothing but what we discussed earlier. Why we need to report, applicability of that, what are the criteria, what are the reporting dates, what are the auditor's responsibility, components of internal control, and there is a flow chart which illustrates the type of flow which is there. Part B talks about the detailed guidance, which goes into each and every point in much more detail, giving an explanation and a technical guidance in terms of how you need to do that particular process. And there are appendices and the CDs which talks about basically illustrative ROMs, internal control objectives, electricity work, WP templates, etc. Now let me start with that basic control question. What is a control? IFCR refers to the policy and procedures adopted by the company for ensuring orderly and efficient conduct of the business. So what is a control? It talks about orderly something which helps to efficiently conduct the business, including adhering to the company's policies. It safeguards the assets of the company. It helps prevention and detection of fraud and errors. It ensures accuracy and completeness of the accounting records. And it ensures the timely preparation and the reliability of the financial information. Now, the question is that when should we look at understanding of this control? Should we do this after the year end? Should we do this before the year end? There are so many questions and all. So before we get into that, we need to also know where this fits into it. And that's where I say that when we look at the risk assessment procedures or a process which we as auditors initiate before starting a particular audit, wherein we try and gather information about the client and its environment, what are the external factors which affects the business of the company, nature of the client, in which business, in which, what kind of the client, listed, unlisted, promoter driven, MNC, who are the, do they have an audit committee, what are the board composition, etc. Business risks which are directly associated to the risk in which they, the industry in which they operate in, and the financial performance of the company in terms of the past information. We analyze this work, we look at these details, we involve our experts to evaluate, understand this. Basis that when we identify the risk of material misstatement is the time we actually go in detail to see that, okay, I have identified that these are the 1, 2, 3, 4 material risk of misstatement in a particular business processes. What are those controls which management has inbuilt into their process to address or mitigate this particular risk of material misstatement, which I have identified during my initial risk assessment. That's a basic place where we look at the internal controls of the company, right? Now let me see how you look at this particular things, right? So if I look at it, we follow a top-down approach or a risk-based approach. Everybody knows about it, right? So we first overall identify the overall risk, as I said earlier, and we'll try and link that to the ICFRs. When we look at that, then we look at the ELCs, which is the entity level controls around that, right? Then we look at the significant account balances and the disclosures and the relevant assertion, very important. And then that will actually direct us to see, we need to verify and understand that particular risk and which are the controls which we need to take to test that control. Now, before I move to a control, why we need an internal control, right? We need an internal control to look at different risk, right? Every control has to actually try and mitigate a particular risk. It may be an inherent risk. It may be a control risk. It may be a detection risk. It may be an audit risk, right? So we will have to map those risks and the controls around it. And what does that mean? Are the balances, transaction, dispersals susceptible to the misstatement? If the answer is yes, then will that misstatement be caught by controls? If it's yes, then we test those. If it's no, then will that misstatement will be caught by audit? It should be yes. If it's no, then we are issuing a wrong opinion. That's where the internal control plays a very important role. Now, how the information processing objectives can help us with the assertion. Now, what is why it is important is basically this needs to be linked to our assertions, and that's how the testing needs to happen. Any control which is not linked to a risk and an assertion or a objective has no meaning, because that will not give you any comfort. Let us take an example, right? If I say that, take an example of an FSLI, which is say revenue in this case. What are those assertions which I look at it in more detail, right? It is completeness, accuracy, cutoff, existence. What could go wrong? I'm just taking an example. Okay, the transaction may not be recorded or must have not been recorded fully or correctly. What are the sub processes which we will actually look at it in detail to ensure that this risk is mitigated? What is the ordering process? What is the shipping? How the invoicing happens? How the controls over returns are there? How the receipts comes in? What is the bad debt and how and who reviews those items? And what are those closing adjustments or general vouchers which are part at the end of the year, which may have implications on the reporting? And this will actually link to the information processing objectives, which is again mapped to our assertion. So what I'm trying to say here is that any sub process, any control activity which you try and map needs to be mapped to an IPO, which is an information processing objective, which in turn gets mapped to the assertions which we are finally going to get comfort of. What is the distinction between a process and a control? A process is a changes or transformation of data or information which introduce the risk of material mistake. What this means? This means is that a process is initiation of a particular activity or a transaction which may lead to risk of material misstatement. A single example, sales process. Now, sales process is a simple process which may lead to a risk of material misstatement, like not accounted of revenue properly, or not accounting at all, or half accounted for, kind of it, right? And what is the control? The control's primary objective is not to transform the information, but to prevent or detect a timely correction misstatement that may occur in that particular process. Now, what does that mean? Is, as I said, the sales, right? The control inbuilt will ensure that you have the GRN or sales, you have an invoicing processing which has been done. Okay, you have lorry receipt which has been issued, right? That has been accounted for and accounted in a proper manner. The transaction of sale has been accounted it. So these are the controls which are put into the process, either automated or manual in whichever way it is, but it is operated to ensure that the sale at the end of the day is recorded appropriately and comply with all the required assertions. Now let us take some example. What this is a process or a control? An invoice is prepared based on the hash of units shipped and price per unit. Is this a process or a control? This is just a process because your just invoice is prepared based on certain units and the price per unit, which is available in your master data. A procedure is performed to check invoice of correct price. Now, this is a control because somebody is checking that whatever I have prepared is right or wrong. Sorry. That means that the process of a material misstatement happening is mitigated by somebody checking the invoice for the correct price. Now let's look at how we identify relevant controls over financial reporting. Some tips around it. Relevant controls are the controls that effectively address the risk identified in the financial reporting. I'm again and again saying that because we as auditors needs to ensure that whatever control we test needs to effectively address the risk identified at our planning stage, that is during the financial reporting. It requires judgment. I agree with you. It can be a entity level control, which is overall, or it can be a transaction level control, like a make a check, how it works out to be. Now, this is really unacceptable you to say that although if there is only one control to cover a particular assertion, it may be okay. But a combination of a preventive and a detective control is generally the most effective. Because in case if one control fails, you have another control to mitigate that particular risk, right? So your risk of you getting wrong is lowered because you have a preventive and a detective mechanism operating effectively. Now we'll look at a 5-step process during the planning stage. Following are the key consideration in planning for an IFC audit. Now, it is very important because when we do a financial statement audit and an ICFR audit, our primary objective at the end of the day, I mean, optically is different because you used to do an FS audit before when IFC was not there and was issuing a true and fair view opinion. It's an additional burden of doing an IFC and doing the testing of control and issuing an opinion. Maybe yes, maybe no. So the idea here is that whenever you plan an audit, it has to be a combined audit wherein the work which you do at the start on IFC is actually fully utilized when you are doing a financial statement audit at the end of the day. The size and the complexity of the company affects the risk assessment. We all know that. And our audit should be customized as an extension to a risk-based approach, right? So our approach, which is a risk-based approach, cannot be the same for all companies, right? The smaller, less complex company may have very less control. You may have single control addressing a particular risk, but largely complex activity should have multiple controls, prevention, detection, risk. So our control objectives are different for each of the size of the company and the complexities involved and the business in which they are. If it's a financial services company, we look at it differently. So you'll have to understand that. Auditors should always start with top-down approach because it's very important for us as an auditor to get comfort over controls first before we go ticking and bashing, right? Before we go looking at substantive procedures at the end of the day, right? Because these are the controls which are actually implemented by the management to address a specific risk which they only have identified through a particular risk assessment procedures. So it's very important that we understand how management is running their business and how management is trying to prevent and detect material misstatement in the financial reporting through these particular controls as we defined, right? So that's how we say that we need to actually look at top-down approach, the way we approach our audits. Now let me start with one by one. Step one, identify the significant account balance and disclosures and the relevant asset. What it depends. You first as an auditor will go and say that which are the material balances. It depends upon the qualitative and the quantitative factors. You will look at materiality considerations, which is same for both financial statements audit as well as IFC audit. You also look at qualitative information like regulatory compliance is one of the risk factors, industry issues. Like in current times, we are looking at climate change. So these are qualitative factors consideration which we need to look at it. So when we look at this, why I'm saying this at the start only we need to do it because your process when you're doing an IFC audit and a financial audit cannot be different. The significant accounts and disclosures will be the same for both, right? And that is how your audit would actually be planned. In case of multi-location audit, your IFC scoping will be based on the risk arrangement in each particular location or a business unit. I mean, that's very relevant because if you have 5 business unit where you have 5 different people operating control differently, then you have 5 instances basis which you need to evaluate those particular controls. Step 2, identify and understand significant flow of transaction. What is this? This is called simple, what we call is a walkthrough, right? We need to understand the flow of transaction related to relevant assertions, which includes how the transaction has been initiated, who authorized it, how the transaction has been processed, and how the same is particular transaction recorded. Now, with this 4 identify, we need to identify the control that management has implemented, right, to address a potential misstatement and to prevent or timely detect unauthorized acquisition kind of it. So what does it mean is basically the management will have control on how the transaction is initiated, who can initiate it, who can authorize it, who can process it, and who can record it, right? So that's how the management. By doing that, management will ensure that the company's assets are safeguarded, right? And there are no unauthorized person who is allowed to acquire, use, or dispose of any of the company's asset in financial, non-financial, PP&E, whatever we can. We also need to obtain the understanding of information system, which is IT systems of the company, and the related business process relevant to that particular financial recording. So as I said that this particular activity needs to be done by the senior management, senior team members of the audit team, rather than keeping it to a junior team member. So we senior members have to get involved in this deliberation and discussions. The step 3 is now you need to identify the risk of material misstatement. We talked about the transaction. We went through the workflow. We understood how the transactions are initiated, authorized, processed, and recorded. We have understood how IT effectively companies transaction get produced. Now we need to consider the likely source of potential misstatement. And this is particularly linked to an analysis of what could go wrong, which means that verify the points within the company's process at which a material misstatement or a misstatement, in whatever way you say, due to an error or a fraud could arise, individually or in combination, right? So what we are trying to say is we have understood the process, we have understood the transaction. Now we have to try and evaluate what can go wrong in this whole process, in this whole transaction, right? Which are the pointers where there is a chances of a material misstatement due to an error or a fraud, right? That is what you have to try and evaluate that. And while doing that, okay, you also need to look at it, previous auditors report. I mean, that's a basic thing. You also look at the internal auditors report if they have identified anything, or there are any special audits which has been done in past which will help you to understand is there any kind of such misstatements been identified prior to that. Now we look at the step 4, which is identifying the controls and addressing the risk of material misstatements. An auditor to test. So what does it mean? You need to identify the control and put in by the management to address the wrong. I mean, that is very simple. What I'm trying to say is that auditors has to test the controls which is sufficiently addressing the risk of material misstatement for each of the assertion. And I'm always saying that anything again and again, anything related to a control needs to be linked to an assertion. Okay. And that's how you need to test it. What is it? Simple logic is that in case of restricted assets to opening an accounting period after the year end in an ERP, addresses your risk of cutoff to say that there are no transactions which can be passed after that a particular date is gone through, right? So there cannot be any transaction which anybody could pass after 31st of March, which to some extent addresses your risk of cutoffs to say that, right? So that's how it is. Now, if there are two controls addressing the same relevant assertion, you need to apply judgment to say that which is the control which is overwriting another one in a way that by testing one control, I am going to cover up the second part indirectly. And then one of them should be part of your testing, right? And right now that control can be actually operated at an entity level control or a process level control. Now, what is an entity level control? Entity level control is basically a control which is more on monitoring, review procedures which the company has, and process level control is more on make a check, and the way it's been built into the system, right? It talks about the control environment, management override of control, period end closing, process level controls. As I said, it talks about each of the control, the way it's operating at the end of the day. We move to the step 5. Identify application associated with IT environment. Now, this is very important because in nowadays, in the current world, most of the systems are automated. The companies are using large ERP. And as auditors, we are relying on those ERPs and the IT environment. It is very important that we need to test this IT environment because the control which is operating at the end of the day may be an automated control or it may be an IT dependent control, right? Automated and IT dependent controls are either built in or used for a particular purpose, right? I mean, it can be an application in which a financial accounting entries are recorded or other feeder application which feeds critical information to the financial reporting data or the GL, right? Again, identification of risk and controls within IT is not a separate evaluation. It is an integrated part of the top-down approach wherein we look at the significant accounts and the disclosures, and then we try and test those controls. Further, we need to also identify and scope the testing. Now, this is very peculiar. We generally, whenever we go, we look at the systems. We say that okay, it's an ERP. This is the books. In this, we are receiving the accounting books. So I will test that. No, I think what is important is that you also need to look at other systems which are there and how that systems are linked directly to the ERP. Okay, there are a lot of times there are batch processing which happens where the data is captured from one system and then uploaded into the financial system. So you need to be very clear on which of those applications you need to perform test on. You need to test the ITGCs. ITGC means internal information technology general controls. You need to test that and then allow the results to come out before you actually try and rely on an automated control. Now, when we are looking at certain ERPs like SAPs, Oracles, PeopleSoft, they have some inbuilt ITGC, like a simple question, you can't put a single entry in SAP. You have to have a double entry system. So these are inherent controls which are built in. But however, there are other controls which still needs to be tested, like backend processing or master access rights or super user access rights kind of it, right? Let us spend some time on scoping ITGC, because today in the digital world, the way we are looking at it, digital assurance, ICAI has already issued guidance on digital assurance. We are moving towards paperless kind of work. Companies are moving towards that kind of a process. So ITGC's relevant IT controls are very important in the current scheme of things. So when you're scoping in an ITGCs, you need to identify the controls again, which are addressing the risk of material misstatements. Now, you need to list down the controls. When you are actually doing a walkthrough and you have listed down the controls, you'll have to see that is that control automation, automatic, or what do you call it, automated one? Is this a IT dependent control? Is this a manual control? You need to classify your controls into these three parts to start with. And then you need to identify the IT systems which are relevant while you are testing that whole business process or a walkthrough which you are going to do at the start. Right? So these are just trying to put it across to say that it's an IT dependent control or is an automated control. It will have implication on IT systems, right? Because it is highly IT dependent. What's included in IT infrastructure, operating systems, database, network? It is nothing but your physical access, the server rooms, and your software elements which are there, right? Which are the operating systems, ERPs, etc. Let's go do our test of some knowledge. We have to test ITGC for all applications that our client uses? No. We need to test only those applications which falls onto the process which for which we are going to test controls for. And I don't need to say that because those controls which we have identified is again linked to assertion, again linked to significant balances, again linked to a potential thing going wrong, again linked to a likelihood of potential misstatements. We have to test ITGCs? Yes. If there is an IT dependent control or an automated control, you have to test ITGCs and you have to get comfort on that. Do we have to, if we have to rely on IT dependent manual control within a process, do we require to test ITGCs? True, right? Because it is a mixture of IT dependent and manual controls. If we substantively test the reliability of the system generated report, that control relies, we only have to test the report one? No, you have to test it times when you are actually generating that particular report. True, correct. As I said, in this case, ITGC work needs to be done on all dependent systems or an independent systems which has a financially significant to the main systems. What could go wrong, right? Step 3 of planning. Say attending a event 400 kilometers from your home on a fixed date and the time in future. So you have planned to attend a event which is as a fixed date, say a marriage and a time for future, right? So what could go wrong? You need to leave from home, you have to travel to airport, you need to do security check, you need to board the flight, you need to travel to the event. Determine what can go wrong. You have overslept it, you have not packed up your suitcase well, there is interruption, there is emergency, you never know what is going to go wrong. Travel at the airport, car is not coming, there is a lot of traffic, your car breaks down in between, you get lost in terms of while going to the airport, you miss out the road. Very, very, very well and quite. I mean, long queues, you never anticipate that. You might forgot an ID, happens sometimes, right? Your bags are selected for additional screening, it happens. Plane don't arrive on time, flight crew is delayed, weathers are bad, traffic jams at the airport. It is quite common today. I mean, if you look at it, Mumbai airport, I can say that due to air traffic congestion, there are flights getting delayed in the evenings and the morning. Again, while coming back, you have lost your luggage, car service is late, traffic. So while we may think positively that nothing will go wrong, but these are instances which are practical in life, which can happen to anybody, and which may hamper your reaching a particular event on time on a particular date. Right? I mean, that's the fact. So all clients have a financial reporting objectives, right? Which is an assertion. For example, all transactions are processed and are processed completely and accurately. Now, the risk to not achieving those objectives may vary from client to client, as I said, process to process, industry to industry. So it cannot be a one fit answer to all, but overall, what we call framework remains the same. What the client's response? I mean, the design of their controls, right? And what we try to say is that we have say that okay, you have designed the controls. What are the specific of our control testing and the substantive profile, right? So what I'm trying to say is that our clients respond to the design and our specifics to the control and the audit procedures will differ based on the client specific factors in each of the processes, the way we talk about, right? Likely source of potential misstatement, right? So as part of, if you look at the guidance note, para, I think 96, yeah, as part of identifying the significant account and disclosures, an auditor should determine the likely source of potential misstatement. And what does that mean? As I said, what could go wrong, right? You need to list down that if a company is doing a particular activity, what could go wrong in terms of this activity not completing the way it needs to be complete, right? And the guidance note para 100 also talks about that, right? It emphasizes the need to understand the likely look of potential misstatement and requires us as auditors in part of selecting the control to first understand the flow of transaction, identify the point within the company's processes at which the material misstatement could actually arise, identify the controls to address that particular potential misstatement, identify that control which management has implemented to prevent and detect misappropriation of asset that could be material. Right? So this is the basic thing which we need to do and which I've been saying in earlier slides also. Let's first try and understand what is ELCs. What is ELC? ELC is a basically control related to a overall control environment. It is a control which prevents management override. A very important point. And what I mean to say here is that this is a control which will ensure that there is no management override when a particular business transaction is happening. It talks about the company's risk assessment procedures. It covers any kind of centralized processing and control, which includes the shared service environment, which is quite active right now, right? It talks about the controls which monitors the results of the operations, not the day-to-day activity of the operations. It is a control which monitors other controls, including activities of an internal audit function, which is a function which monitors the day-to-day controls, audit committees, self-assessment programs. I mean, nowadays large companies have come up with these self-assessment programs for senior management and the board. That's very important because then it talks about how they have performed by themselves, like what we have self-appraisals. What are the controls over the period and financial reportings? Control over how an unusual transaction gets recorded, because this unusual transaction is not a day-to-day activity which may be covered under all the processes. Okay, policies addressing significant business controls, business practices, as we discussed, right? Focus on ELCs. I mean, again, I'm trying to showcase the paras in guidance note because the guidance note is so well drafted that you can just pick up that guidance note, go para by para when you are doing your audit. I think most of us will ensure compliance with that. What it talks about 88, the auditor must test those entity level controls that are important to the auditor's conclusion. Auditor's evaluation of entity level controls can result in increasing or decreasing of testing, right? Because if everything is working well at the top, at the tone, at the top, then it is bound that the process level controls are also working effectively because there is somebody who is checking that the process level controls are working effectively, right? What are the type of ELC? Uh, Indirect controls. They are not directly impacting the risk of material statement at an account and assertion level, but it's a very effective control. For example, audit committee members or a senior management members review a particular activity in a particular manner that may not directly hit the assertion, but it is an indirect control, right? This might affect the other controls which we select for testing, right? And the way we procedure and perform the testing of those particular control will have a some kind of an impact. The second is direct, that are not precise enough, means these are directly addressing the wrong or at an account and an assertion level, but are not precise enough of their own to fully address the risk of material misstatement. What this means is that this may be one of the control, like a review control, which may not fully address the account or assertion level, but it can be a strong control if it is supported by any other process level control. So it directly impacts wrong, but not precise enough at a standalone level. And the third is an ELC which directly and a precise enough hits the particular assertion, right? Now let us put at a question. An assistant controller conducts an annual financial reporting conference attended by all subsidiary. Corporate accounting policies changes, financial risk reporting, control activities where there are new financial objectives are discussed in that particular meeting. What does it mean? It is an indirect ELC. So what does indirect means? While it's a control where A controller is actually telling all the subsidiary controllers what are the changes in the accounting policy, what are the financial reporting risk associated, and what are the control activities necessary to respond. So he is telling them that this is the process you need to follow going forward. Right now, it does not impact directly that risk of material misstatement because this is not the process to address that, but at least it is directing those people to ensure compliance at the process level. That's the reason we say that it's an indirect ELC. Take one more example. The management performs a trend analysis of revenue recognition during the year on year. This is a direct ELC and not precise. The way I give you an example only, right? It means what? It says that, okay, it reviews end-to-end trend analysis, revenue of current year revenue. So it may somewhere come up to say that, okay, is the analysis proper? Is there any unusual items? Why the revenue has moved up? And there may be reasons, there may not be reasons. So it's a good control to have because you get an insight from an outside perspective, so inside out perspective, overall numbers, but it does not directly give you comfort on any of the assertion within the revenue line item, right? But when I link that particular control with the actual process driven control at an FSLI level, I may get a good comfort around it, right? One more. The sales director perform a review of a monthly sales figure in comparing actual with forecast and target and establish at the beginning. Now, what does this mean? Again, it's a direct ELC, not precise, because here it gives him an idea again that my sales versus target is moving up and down. What is the reason why it has happened, right? So it gives an indication, is there something wrong which is happening? So that's a direct ELC, but not a precise one. Now, this is what is very important to say that this actually means that the controller actually is going into detail wherein he is picking a particular FSLI or a line item, preparing a variation, looking at the lease premises worksheet, coming up with an explanation to say what is right, what is wrong. So this is a review control, direct ELC, very precise, which will give you comfort on that particular session. The code of conduct, robust anti-fraud policies program, which is the tone at the top. These are direct ELC, indirect ELCs, right? It is a tone of the top, directly not related to any line item, but it says that, okay, this is how I'll do my business. This is how anti-fraud programs I'm running, which will prevent the process level controls, processes to ensure that there is no fraud happening in the way the transaction has been flowing into it. Now, extent of testing, right? Indirect uh, does not need to be extensively tested because this will not give you full comfort, right? This will only give you an indicative comfort. But when there is a direct ELC, you need to apply the sample size based on your own guidance, and you need to follow that and do the testing of that particular control. Let's move to the next one, which is understanding the process level controls. Transactional business process. What is it? This includes control activities over initiation, as I said, recording, processing, and reporting. Of course, of a voluminous transactions, different type of transaction, but routine process transaction, not unusual, throughout a reporting period. Such processes are generally fundamental. The way in which an entity generates revenue and incurs expenses. It may be highly reliant on information technology systems and applications. Sorry, as the current world talks about, right? IT system, digital assurance, digital world. There are greater number of controls that are expected to be identified in this particular process because these are transaction level or a process level controls, which you need to test, and this can be directly linked to a particular assertion and likelihood of possible misstatement or what could go wrong in whichever way you say. Periodic business process, this is basically control activities over initials recording process of lower volume of transaction, including significant one-time or infrequent transaction, right? This is basically where you have large business transaction, little bit unique transactions, right? This may be fewer in a year. To that extent, that means the number of controls would be less enough, right? Or there may not be any direct control. So you need to assess how that particular control needs to be looked at it when we are looking at this kind of transaction. Also, we need to try and bifurcate our FSLI into these two category for us to come up with an effective control assessment. Because a routine transaction control may not be working well when there is a one-time, infrequent, significant transaction which happens, right? Because that requires more supervision, more review as compared to a routine business level transaction. Let's move to assessing, designing, and implementation of controls. When we test controls, where do we start? As I always said, we need to understand what is the purpose of the control. First point, exactly how this control operates. We need to know that. Specific activities, how the control has been designed, how it acts, what it impacts. If this control is an automated control or an IT dependent control, we need to also check the ITGC, which is the Information Technology General Computer Control, to see that is it effective or not. Fourth one, I mean, this is a very important one and we sometimes miss that, right? The source of information used in executing that particular control and the reliability of those information. I mean, there is always a misconception that a review control where a manager reviews the list of datas to identify is there is bad debt is a manual control. You need to also understand that the list which is prepared comes out of an IT system. And if that IT system we do not have effective comfort, you cannot rely on that list which is used by that particular manager to perform that particular review control. So we need to know the source of information and where it coming from. You need to ask yourself, how much evidence do I need? And what type of evidence I need to support my conclusion? Is this evidence collaborative, persuasive, and it will help me to close on to my assertion level comfort? These are the things which you need to do as we start testing controls. What do you mean by persuasive and collaborative? These are the two words which I used just now. Persuasive means convincing, believable, creditable. Collaborative means it is supportive, substantiated, back. You can't have only persuasive, you can't have only collaborative. It has to be, in simple word, both your qualitative factor, which is your mind, should get convinced, and a collaborative factor, which means your eyes should get convinced with the data which is available on the ground. Right? Now we look at again level of precision and what level control risk you need to look at. The purpose of the control would determine the level of precision. The aggregation at what aggregated level that control has been obtained. Like giving you an example, if a controller looks at basically sales overall data and say that, okay, I'm fine, vis-a-vis a controller looks at each of the party in aging that particular data buckets and also looking at email correspondence to arrive at the conclusion that there is a what you call provision required or not. That level of precision is much higher. More the level of precision, more comfort you get, right? You need to look at basically consistency of performance. Is this particular control being performed at a regular interval consistently? Is it hitting the right relevant assertion, as I always said, right? Right. Another thing is predictability. And now, I mean, how he looks at it is very important as a control. I mean, he also needs to bring in some level degree of judgment while performing that particular activity. What is the level of control risk? The greater the consequences when a control fails. More difficult to identify the control, the risk is higher. More changes that are occurring, where the control like people changes, transaction, processes, etc., where the control is applied, the risk is high. The lower the level of the precision, as I said, higher the risk associated with the control. And we need to do more evidence and we need to keep on testing on that. Let us summarize. Effectively designed controls can effectively prevent and detect fraud. Very simple. Designed to be evaluated, again, it should be a mix of inquiry, observation, inspection, and look at a particular activity in a detailed manner. Only inquiring with the management will not give you an appropriate or a sufficient evidence. You also need to check that the person who is performing that particular control should possess the relevant authority to actually perform that control. As I said earlier, greater the risk, inherent risk, more precise the controls are expected to be. Segregation of duty are always considered or an alternative control which needs to be evaluated. If there is a strong segregation of duty, that can be considered to be a very strong control. But that is not always possible in a smaller type of countries. So it is good that we should not go in detail on SODs and try and look at alternative controls. Sorry, just excuse me. What are the common pitfalls we need to keep in mind? The information which is used in operating a control should meet the objective of the control. A person who is reviewing bad debt should not look at sales number, it should look at receivable numbers, right? The information being used is at appropriate level of detail and control operator is able to identify an error if there is any. Who generates the data, from where the data is generated, right? And what is the source, as I said earlier. How important is that data to achieve an objective of that particular control? I mean, you also need to evaluate qualitative, that is this data relevant enough for him to actually perform that particular control activity. At the end, how the management assess that completeness, accuracy of the data which has been used. So at the end of the day, what is important here is to see the data it has been used. Is this relevant? From where it has been taken up? And who has given it? So these are the three parameters which you need to look at it, which we sometimes miss on that. You need to identify all the key reports. I always said, right? Whenever there are key reports, you need to test those key reports differently, right? If there is a system generated key report, we need to test the systems to ensure that the key reports which are generated can be relied upon. Spreadsheet errors are not uncommon. If a report is prepared on a spreadsheet, you need to have controls which needs to be tested around how that particular report is managed. What are the spreadsheet controls which are inbuilt by the management on that? Then we talk about the plan and perform the operating effectiveness of the control. We need to plan the nature, timing, and extent of operative effectiveness, right? In a combined audit, integrated audit, in whichever way we say, ICFR and financial statement audit should design testing of control to accomplish both the objective, right? Both IFC as well as financial statement objective together. While planning the nature, timing, and extent of operating effectiveness, as an auditor, we should consider the risk associated with the control and the risk of material misstatement which the control addresses. The control test should be performed on sample spread throughout the period with at least few sample tested closer to the year end. Because anyway, you'll have to give the control as of 31st of March, right? So you can't say that I will only test one quarter and I should be fine for the whole year. So that's what the point is all about. The extent of testing would depend on two or three factors. One is the frequency of control. If it is quarterly, out of 4, you may test 2. If it is monthly, out of 12, you may test X number. If it is daily, you may test X number. It is multiple times a day, you may test an X number. So it depends upon the frequency of the control. It depends upon if the control is manual or automated, and whether the underlying IT controls are dependable or not. I always say that the nature of testing should be the combination of inquiry, observation, inspection, and reperformance. You can't test control only based on inquiries. You may apply a dual purpose test wherein auditor may perform substantive test of transaction concurrently with the test of control. The test should be planned for dual purpose, and combined test should address both substantive and the control objective, right? So you can plan it, but you can do it, but you need to plan it well. System reports needs to be tested if the report is used for the controls being audited, and effort is used for the substantive procedures. Very simple. I've been saying this almost in all slides. Now we have tested our controls. We have understood how to test. We have tested it. Now we need to evaluate the identified control deficiencies, right? So when I look at control deficiencies, I mean, there are three types of it, right? One is a control deficiency, right? One is significant deficiency, material deficiencies. Is this deficiency a design deficiency, which means the control never existed, or the control was not well designed, not operating, right? And the second part is this is an operative effectiveness deficiency, right? The auditors should modify the audit report on internal control for financial report if the identified deficiency individually or in combination has been assessed as a material weakness, as we all know about it, right? What are the factors which is to be considered by determining the severity of internal, right? The qualitative factors and the compensating controls. So what is the likelihood and what is the magnitude? If likelihood and magnitude comes together, it's a material weakness, clear, right? So that's the way it is. So what let us take some example. If there are material control deficiencies that affect the same account balances or disclosures, increase the likelihood of material misstatement or a material weakness. When we have this, we need to look at compensating control if there are any, right? We also need to assess the aggregation risk of the control deficiency. So what it means is that there is a control deficiency. Of course, it is impacting a significant balance because that's how we started off. Is there a compensating control around it? If there are no compensating control, we try and aggregate those risk of control deficiencies together, right? Because you may have multiple controls in a particular process. One or two may fail, others may working well. So we need to aggregate the risk of control. We have to look at it. Is there is an impact on the summary of aggregated deficiencies or summary of uncorrected misstatements? One we look at is all. We'll have to look at it, and then I mean a material weakness in an internal financial control does not mean that the financial statements are materially misstated. So you may come up with an argument to say that controls are not working effectively. That's fine. So your IFCR is qualified, but you do additional procedures. You have done substantive audit procedures, and you have found that everything is well to an extent. Your financial statement may go clean, but your ISA opinion may be qualified on that. Sometimes, while client says that I have a control, it is not well documented, right? So we need to look at it. Does it relieve our responsibility to understand and evaluate control? No. Right? Does it eliminate the need for us to have documentation? Yes. Does it mean control do not exist? Possibly no. Could it be a control deficiency? Yes. You need to ensure that any control deficiency which you identify, you should issue a management letter wherein you tell the management that and during our audit process, while there is no material weakness, these are the 8-10 control deficiencies which we have identified. We request you to correct the same. What are the other considerations in an audit of an IFC? Review what kind of type of controls we need to look at it, remediation testing, subsequent events, and what how you communicate certain matters. Review type controls. The review type controls are those controls whereby a control operator reviews certain information and takes other necessary action based on the results of the review. The way I told you, right? Earlier. These are review of JVs, reconciliations. These are actually BPRs, final calculations, review of effectiveness of other controls like internal audit does, right? I mean, large impairment testing that has been reviewed, estimates are generally reviewed. So these are some of the examples of review control. When you are evaluating a review control, and as I said, the quality of information and the reliability is very important of the data which is there. Second thing is the person who is reviewing it is competent and skilled to actually review that particular data. Okay. And third is whatever is the outcome coming out of the review, is that particular implementation happening the way it needs to be. The auditors should actually assess the risk associated with the review control, whether performed by an individual or a group is higher due to the subjectivity and the complexity of such controls. Because here you have a human mind which is coming in, you have a judgment which is coming in, you have an estimate kind of a concept which is coming, right? So you need to also look at overall ELC around it, overall design effectiveness around it before looking at it. You also, very important is that it's not about what he reviewed. You also need to look at the notes which he have prepared or action points which he has prepared during this particular review, and has that action point been actually actioned on the ground. If that is working well, your review control is effective. Again, testing of operate review control, as I always said, 2 or 3 things you need to keep in mind, right? Okay, you need to obtain evidence that actually the review is obtaining. And the second, very important when you look at the review control, is the level of precision at which this particular review control is operating. At what segregated or a disaggregated level the data has been reviewed by that particular individual. Technique remains the same: inquiry, observation, inspection, and re-performance. Testing of operating event is a potential type of evidences. We look at it. A detailed memorandum that outlines the considerations, the checklist, the program which describes the procedures, email exchanges, correspondence, interviews, discussions, interactions, minutes of the meetings, right? All these things can be considered as a potential type of evidence. It's a no size fit for all. I mean, as I always said, sign off is not enough. You need to look at the action points. Sometimes you may want to attend those meetings where the review is actually getting performed to actually see how things happen. So it's up to you. I mean, it's not, this is something which you can't have same for all companies in all industry. It varies. It varies from complexities, size, level, etc. Subsequent events. We need to ensure that the IFC, which is there, which is where we have given comfort on 31st of March, is working effectively as that. Is there anything which has hampered that controls? So you need to inquire with the management. You need to take a management representation around it. You should look at the internal audit reports which are issued subsequent to the period end. You should look at any regulatory agency reports or any kind of regulatory filings they have done after the year end, right? You should also look at the board minutes or other internal documents to see that is there any kind of a reporting of any failure on IFCR. The subsequent events prior to the issuance of report on IFC, it is similar to what we do in financial statement SFI 60. I mean, it's equally applicable to IFC, right? Anything which is materially or adversely effective, the effectiveness of IFC, as at the balance sheet date, adverse opinion, unable to determine the effect of the subsequent event, disclaimer, similar to what impacts our normal financial statements audit. Again, the same thing which I said about IFCR, right? If subsequent arises to date of assessment prior to issuance of a date and a material effect on an IFC, a paragraph can be inserted into your report and also may part of the audit report. So it depends how things progresses. It depends what is the actual ground reality, what has happened on the ground. All the subsequent events which has affected or which has happened after the issuance of report, you should discuss with the management and the chose charge with governance, and also evaluate the impact, because this is an ongoing process. After we have signed off with something has come to a light, you should discuss with the management, discuss with audit committee, and see is there any impact on the opinions which you have issued. We move to the last one, which talks about communicating certain matters to whom. Just a simple table which I put it into it. Said all control deficiency, yes, we should communicate to the management, as I'm saying, may not be to those charged with governance audit committee. But of course, if there is a significant deficiency and a material weakness, you should communicate to the management as well as those charged with governance, which is audit committees and other independent directors. I'll just move to the last slide before we open for questions. Basically, what it means is IFC audit is a natural extension of a risk-based approach. You need to look at it in each of the control or a process. What could go wrong? What is the likely or potential misstatement? And then link that control to mitigate this particular risk. As I always state, when you're testing the controls, inquiry is not sufficient. You need to have both persuasive and collaborative evidence for concluding that the control is effective. Planning is very important in this case, and senior team members should be involved, right? Auditors has to report on the design and operating effectiveness as at the balance sheet date, not throughout the year. The complexity and the precision of control will be dependent on the risk involved in it. ITGCs, I always says, you need to be very clear on what kind of control it is. Is it IT dependent control, where a report is used which are generated from IT system? It's an automated control or a manual control. You should ensure that you have enough comfort on the IT environment of the company. And lastly, if there is a significant deficiency or material weakness, you should report to the management and those charged with governance. Thank you very much for hearing me out. Happy to take any questions. I'll just stop sharing my screen.
Thank you so much, sir. Can you hear me? Sir, can you hear me, sir?
Yeah, I can hear you. I can hear you.
Sir, first of all, sir, thank you so much. I missed to apprise all the members that my sincere thanks to you in spite of having fever, cough and cold, and you have exceeded. And the last night you were down with the fever, and you have so much of the passion for our profession as well as our members that you have given your consent that yes, of course, you will deliberate as you have committed. So hats off to you, sir. Thank you so much once again.
Thank you.
Spite of having the bad throat as well as the fever, down with fever, taken so much medicines, antibiotics, and you have spoken almost 1 hour and 45 minutes, sir. Thank you so much, sir. Thank you so much.
Thank you very much. Thank you very much for your kind words. Thank you.
Sir, I have received certain questions. First question is very simple. One member is asking, what are various limitations of internal financial control, sir?
So I think, as I always say, if there is a limitation on an internal financial control, then ideally that cannot be a control. Let me start with that. But having said that, I think, as I always say, that when you are assessing a control, don't do it because there is a control. First, you need to assess if that control addresses the risk of material misstatement. If it addresses the material mistake, it is worth actually testing that control. Then again, when you are testing that control, you need to see if it is IT dependent or automated. If it is IT dependent and automated, it's very important that we get comfort on the IT systems of the company. Here, sometimes we miss out, and that may be a inherent limitation. I think I would put it that way. So it's very important that we take cognizance of how we actually get comfort on IT system before we test those controls. Is my view.
Yes, sir. So, in case of there are certain companies, certain societies, so how to maintain internal control in societies, sir?
I mean, it will be the same way, the way we do it for companies. Of course, the controls would be in case of societies. I think there will not be an IT system which will be complex. So you can't have control or a comfort on IT system. They will have a simple tally or something like that, right? So there, I think the
Yes.
management committee plays a very important role in terms of what are the controls which are listed down. So there are societies where they have a rule to say that any expenses above say 500 needs to be approved by the committee of three. The check needs to be signed by two. If it is beyond a particular amount, the society members needs to have a meeting. So if there is a list of controls which society has implemented, those controls as an auditor we need to test to ensure that it is working well. Having said that, I don't think so for society we need to issue an IFC opinion as such.
Sir, one member is asking, we are external internal auditors of a listed company and
Hmm.
supporting the in-house internal department of the company.
Hmm.
We submit our report to in-house internal department and the internal department forward few selected issues we did not know and we do not take part in audit committee. Do we have any responsibility in that?
I mean, internal auditor has this moral responsibility. That is first.
Yes.
Second thing is, I think most of the audit committees I have seen, internal auditor always come and present that report, though it will be summary of key issues. The auditors of that particular company will always ensure that he goes through the whole report of the internal auditor and not only the summary or the key findings.
Yes.
And my suggestion, we should insist the management to request internal auditor to attend those meetings.
Yes, yes, yes. So small companies were managed by two or three
Yeah.
directors, normally not maintain any internal control policies, and books of accounts are not updated on day-to-day basis. And as a statutory auditor, how to verify the internal controls when it is not existed? That is
So how will you
not available
verify
in
it?
written.
How will you verify if there is no internal control? I mean, what am I supposed
Yes,
to
yes,
comment on
yes,
that?
sir.
It is a problem.
Yes, sir. And again, time allotted to the statutory audit is very less in order to verify internal control.
Yeah. So generally, the way we do, sir, is that the best practice is that when we are doing an IFC, we should do it before the year end. It gives two purpose. One is it gives us time to test those controls, and secondly, it gives time to the management to remediate if there is any deficiency before 31st of March.
Yes, sir.
Because if you do it after 31st of March, you can't do anything. If there is a deficiency, it's gone. I mean, you have to report. Management will have no choice, and you will also not have choice as auditors.
Yes, yes, sir. Sir, one last question.
Yeah.
Can you please elaborate certain latest internal control checks that we can apply those on NBFC?
Uh, I am sorry. So as I said, I mean, I am not a expert in a banking sector.
Yes,
So I may not be the right person to give guidance on NBFCs. I don't want to say something which I don't know actually. I'm sorry about it.
yes, 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 yes. So thank you so much, sir. These much questions I have fetched till now. As soon as I will receive more questions, then I'll forward to you through mail, and I'll respond the queries answers received from you to the concerned members. So at this
Sure.
juncture, I would like to again thank you, sir, for sparing your valuable time and acceding to our request on this very important topic. Plus, as I mentioned before, in spite of having down with the fever, you have spoken for 1 hour 45 minutes. Hats off to you once again, sir. And on behalf of WSE of ICI, I extend my warm and heartiest thanks to you for spending your time, sir. Thank you so much,
Thank
sir.
you
Thank
very
you so
much
much.
for giving me an opportunity.
Thank
Thank
you,
you,
sir.
sir.
Thank you, sir.
Thank
Thank
you,
you, sir.
everybody. Thank you.
Thank you, sir.
Thank you.
Hmm.